All right, Sandra from Florida, Section 179. Okay, this was an interesting one. I took quite a few hits on this the other day when I said I was in a video, I was kind of against it. I'm not against the utilization of Section 179. If you don't know what that is, that's where you can buy a piece of equipment and depreciate it all in 1 year. Essentially, in basic terms, that's what it is. I need a $100,000 piece of equipment. I now can write off $100,000 on my business tax return as it relates to the purchase of that. I don't think it's a bad thing. I don't think it's something that you can go against. What I'm concerned about is all of how the business looks and what's the health of the business prior to making that decision. So the very first thing I have to look at is if you're going to buy that piece of equipment, there's a payment there, right? So a $100,000 piece of equipment, let's just estimate that the principal on that every month is going to be $8,000. What you've done in making that decision is you changed the complexion of your business. And you changed it because now, after taxes, first and foremost, you have to make $8,000 every month. So if your business doesn't make $8,000 after taxes, which essentially means that's probably closer to 11, right? $11,000. If you're not making that, or if you make that decision, you're actually making the decision that I have to make this in profit. So again, you can buy the equipment for $100,000. You can write off, the amount in 1 year. But what happens next year? Are you going to buy another piece of equipment? Is that second piece of equipment going to be $100,000 as well? And whatever profits you were supposed to make. So the $8,000 at the end of the story, over a year's period of time, that means that company has to make a total of $96,000 after tax. So if there's no debt in that company and they can handle the $96,000 after tax, then that's a good decision. But the second part of that is, that's debt service. So, Sandra, the thing is you have to be able to look and say, can my business handle the debt service on that $100,000 piece of equipment? If it can, it's a good decision. But the second part of that is, what is the working capital situation you have in your business? There is a thing called working capital required. There's a thing called working capital actual. And based on what it really means, it's not cash. What it is from the point you make a sale to the point you get your final payment on that sale itself is called a working capital cycle. And really the quick and dirty math is, how long in days does it take for you to start a sale of your product or service, and how long does it take you to get your final payment on it? So if it's 45 days, right? If it's 45 days and that's the cycle, and it's not your accounts receivable cycle, it's the working capital cycle, a little bit different, but we'll just make it simple by saying it's accounts receivable. If it's 45 days, and to run your company every day, including all of your direct costs and all your overhead and so on and so forth, I'll use a round number just for quicker math. If it costs $10,000 to run your company every day, and again, that's all costs, and how you figure that out is you take your total revenue and you deduct whatever profit you produced. Whatever's left over, right, you divide that by 250 days. That's roughly how many days you're open in terms of business. And whatever that number comes out to be, that's your daily expense. So now I know I need to cover 45 days of collections at $10,000. So I need $450,000 of working capital. Now again, that's not just cash. What you do to measure what you have in terms of working capital is you look at all your current assets and all your current liabilities. So current assets are cash, accounts receivable, inventory, whatever all those add up to, it's on your balance sheet. It should say, current liabilities or total current liabilities. Let's say that number is $1 million. And the current liabilities, which is accounts payable, your current portion of long-term debt, in other words, how much you've made in principal payments on that debt, could be other items, but the difference between those two, and let's say that the current liabilities in that company is $800,000. So the difference between the two the current assets and the current liabilities is 200,000. And that's how much working capital actual that company actually has. So what they need is 450. What they have is 200,000. That $250,000 variance is where businesses feel this cash crunch, right? They're robbing Peter to pay Paul. So if those two values are in a deficit, right? In other words, a deficit of 250,000, then buying that equipment again is a bad choice. And the reason why is either I'm buying it from my working capital, because that's what they'll do. They'll take and buy that equipment from the working capital, or I'm in a position that by taking on additional debt service, if I'm not making that profit to cover that payment every month, then it's going to come out of this pool here. So it's a long answer, but it's a correct answer. If it's confusing, this is a short video. I'll go into it in detail later on, but you got to check your debt service first and foremost. You got to check your working capital second of all. If both of those are healthy, then making the decision to buy that piece of equipment and writing it off by using Section 179 is an actual great thing. If your business is in trouble in any of these two areas, it's not a good decision. And your accountant is telling you or giving you the advice to do so in your business, and these two are unhealthy. And again, these aren't measured by accountants. This is not accounting. This is actually finance in a business. They are health indicators in a business. They are leading indicators. They're not lagging indicators. So if your accountant's giving you that advice, it's because they're giving you advice from their view of the business, which is simply, I want to lower my taxes. So what can I use to lower the overall outcome? If I can lower the income or lower the profits, I can lower the taxes. So the advice they're giving you is sound, but it's inside a small box. You have to look at the whole macro picture of your business and be able to make a decision based off of these two primary areas. Then you could say that it's a good idea for you. So I hope that answers your question, Sandra. Yes, thank you. Thank you. All right.